Okay, we will proceed to theory of constraints and throughput accounting. What is theory of constraint and throughput accounting? It was proposed by Cordray and Cox. TOC is an approach to managing costs and improving quality and delivery performance by focusing on identifying and remove bottlenecks or constraints. Bottleneck theory. According to the Holmgren 2005, bottleneck theory is an operation where the work requires approaches or exceeds the availability of quantity. Based on this diagram, we can see that machine A and C are unlimited capacity, while machine B is bottleneck. The rate of production is limited to the capacity of the constraint of bottlenecks. The example of the constraints. First is equipment. The way equipment is currently used limits the ability of the system to produce more sellable goods or services. Second, labor. Lack of skilled people will limit the system, so mental model held by people can cause behavior that become a constraint. So, production cannot flow through the plant faster than it can move through the bottlenecks. In the short term, the rate of production through all areas should be limited to the rate at which product can pass through the bottleneck. In the long term, management effort should focus on removing bottlenecks. Any attempt to improve efficiency in non-bottleneck areas will not improve performance. Inadequate labor or machinery can cause bottlenecks, so labor resources can be improved with overtime, hiring, and training. While constraints involving plant and equipment are more difficult to rectify. Another method to relieve bottleneck is eliminate idle time at the bottleneck operations. Second, reduce setup time and processing time, and improve the quality of the product manufactured. Advantages of TOC. First, increase revenue. Second, can reduce costs. Third, can improve customer response time. Fourth, improve quality. 5, act as defective units.
So, what is throughput accounting and how does theory of control relate with it? Throughput accounting is a principle-based and simplified management approach that provides managers with decision support information for them to improve their profit. According to this throughput accounting approach, the ultimate business goal is to make money. This throughput accounting approach is relatively new technique in management accounting, which identifies factors that limit an organization from reaching its goal. It focuses on simple measures that drive behavior in key areas toward reaching the organization goals. Throughput accounting is an alternative to traditional cost accounting that proposed by Eliyahu M. Goldratt. Throughput accounting is neither cost nor costing because cost accounting primarily focuses on cutting costs and reducing expenses for organizations to make profit, while throughput accounting is a cash focus and does not allocate all costs. It only focuses on generating more throughput. Throughput accounting pays particular attention to the concept of bottleneck, which referred to as constraint in theory of constraint, which has been discussed before. There are two main concepts in throughput accounting approach. First, all costs in production are fixed in a short run, except material costs. It is considering laws of variation, which only costs that vary totally with unit of output, such as raw materials, are allocated to product and services. Second, the use of limited resources, which is the bottleneck, should be avoided when producing the inventories. Throughput accounting is a management accounting technique that used as the performance measure in theory of constraint. So, an organization needs to measure the effect of bottleneck and operation decision using financial measures of throughput, inventory, and also operating expense. Throughput measures rate at which business generates money through sales. It is net sales less totally variable costs, generally cost of the raw materials. Throughput only exists when there is sales of product or services. Second, inventory measures all money that business spends in buying things that it intends to sell. And the last one is operating expense, which measure all money that business spends in turning inventory into throughput. It includes all expenses such as utilities, rent, taxes, payroll and maintenance, except cost of raw materials. The impact on profit of change in any one of these three measures can be identified easily. When throughput is increased with no change in inventory or operating expense, then net profit, return on investment and also cash flow will increase. Likewise, when operating expense decrease with no change in throughput or inventory, then net profit, ROI and cash flow will increase. Decrease in inventory will also increase profit, return on investment and also cash flow. This measure can be used to guide decision making and also assess performance. Now, let's take a look on the real example of companies that use throughput accounting.
The throughput accounting system takes out a lot of the noise, the absorptions, the overhead absorption, the direct labor absorption, all those little things that can drive poor behavior.
When we used to use cost accounting, the focus and the emphasis was on our absorption rates were correct, our overhead rates were right, everything but really how to keep track of are we making a good product in a cost-effective manner.
Throughput looks at the money that's going out the door and the money that's coming in. It's not related to some fictitious absorption number that can be heavily influenced by mix and so many other things. It's more about just what the bottom line of it is. If it's not generating a good throughput for the amount of effort we have to put into it, then it may not be worth doing the way that we're looking at it.
We were able to take one product group that we thought had a low EBITDA and realized that it actually had an opportunity to generate a lot of throughput, and we had those machines sitting idle about 65% of the time. Now they're 100% utilized on both lines. So
the beauty of it is, of throughput accounting, is that it's so easy. It shows you the good and the bad and its total glory, but it's very simple for non-accountants to understand.
It made it easier for me when I estimated a job to know whether or not it was a profitable job or not.
Our year-over-year financials, our net income level are just amazing for what happened last year versus this year. It's just it's been an incredible turnaround for us.
Every management accounting technique has its own advantage and disadvantages. For throughput accounting, advantages are it focusing sales effort on those products that truly make more money. The second one is it has better judgment on which investment will contribute to generate more profit. And the last one is it is more realistic reporting of the effectiveness of the system for an organization. The drawback of this throughput accounting are, first, it focuses mainly on the short-term performance. And the second one is the company are not willing to change and they are preferred to keep traditional accounting legacy. And the last one, it focuses on the whole cost of the operation, which make it complicated for the organization.